Welcome back. We are Smart Money today. We are discussing insurance, the ins and outs, over-insurance, under-insurance, and how to get the best deal. Walter, before we went away for the break, if I'm looking to buy R1 million life cover, there's a cost to that. But if I've been promoted, I now earn double as much as I used to, and I've taken out a bigger bond than I used to, and I want more life cover. The insurance quote doesn't come back as 3 times as much to go from R1 million to 3 million. How does this sliding scale work in pricing a risk?
There are various risk factors that affect premiums. So gender is one, age is another one, region is another one, so where we live, and a major aspect is salary. So what you've just mentioned there, that you've now got a promotion, you've got a salary increase, so your risk profile changes based on that salary. Because the way you apply the salary in terms of how you live, so medical care, the type of food you eat, the car you drive, the area that you live in, all of that affects your risk. In other words, the risk of claiming or the risk of passing away in terms of life cover. That's why the premium is not a straight ratio.
Okay. Warren, what else can you give me on the pricing expectation? Because sometimes say, well, I can barely afford the $1 million, but you actually need to up your insurance cover, but you're afraid and you're doing your home calculations, saying, well, let's go from $1 million to $1.5 million, it's going to cost me 50%. Well, I can't afford that. And then you remain underinsured.
So, and the question is, can you afford not to? And that's really the issue here is people who desperately need insurance are obviously the ones that are often most at risk financially. And so that trade-off that they make about, I mean, having those extra few cappuccinos or actually getting the cover that your family needs is an important decision. And to me, I think there are a couple of things there. I mean, and it'll be interesting to get your views as to how I can look at getting lower premiums. In the insurance industry, we're talking about that you can raise in excess. I guess if you're healthier, that helps you to some extent. I guess if you're younger, that helps. And I need to earn a bigger salary, but sometimes you can't control that. So are there any other ways of reducing that premium?
Yes, there is. Insurers do offer long-term insurance now, life cover, on a term basis. So we all know our needs change over time. So a term would be for the next 10, 20, 30 years, as opposed to what they call a whole life policy that just carries on forever. That's one way of adjusting the premium.
And is that much cheaper?
It's much cheaper.
Okay, so can I hear or try and make an analogy? If I am buying a policy that says the Bulls will win the Currie Cup for the next 20 years, that's a term policy. That's versus saying they're never going to win the Currie Cup ever again. But to say never in an open-ended term, that's a whole life policy.
That's correct.
I'm with you. And they aren't going to win.
And I hope they do in the next 100 years. The interesting aspect, if you look at insurance worldwide, the term cover that I just mentioned is quite popular and big overseas. So I'm talking Europe and in America because it's so affordable and because it's for a specific term for those people and their needs change. Whereas in South Africa, and that's another debate, I'm not sure why, but it seems to be that more of the long-term or whole-of-life policies are sold on that basis. Which
does it make me more commission if I'm an agent?
I was going to put it in that direction.
Isn't it as simple as that?
Yes. Okay. There is more commission on a whole-life policy versus a term policy.
So if I want to take life cover, coming back, I've dodged your answer a little bit. So if I want to take life cover and I'm 25, then maybe the suggestion is take it only to your age 50, let's say, for example, because by then you should have saved enough money to have enough cover, and you can always review at that point, but don't take it for whole life.
Yep. Well, the term of your bond, if your bond is 20 years or 30 years, you know you're going to need that cover for the period. I mean, the outstanding amount will reduce over time, so you know you'll have sufficient cover, and that's maybe another good rule to apply when you're taking cover for a bond.
And what about stepping down the cover that you have? So you start with, I need 10 million because I'm 25 and I've got 2 youngsters and I've got a huge bond, but by the time I'm 50, I'll only need 2 million.
Sure, that's another way of doing it. You can step it down. The difficulty there is to assess when to step down and by how much. Because bond is a big one, but you may have other debt that you do accumulate over that 10 or 20 years. So I would always say rather keep it set for an amount. You can always add to it, and yes, you can always remove. If you know for a fact you've now settled up my bond, I don't need that big amount anymore, but don't take it all away and don't be too aggressive to reduce. Because then there's another aspect which is underwriting. You know, medical underwriting, we all age and we don't all stay healthy. So you might find that it might cost you more if you need to add that cover back later.
Okay. Just a quick one. Funeral policies sold over the phone in 2 seconds. on average, are we over-insured in the funeral policy sector?
My gut feel says yes, we are, definitely. There is a debate over the cost of a funeral because there's different needs. It's not just the basics as we all think. There may be other aspects that also is a burden on the family and needs to be covered. But as a rule, people are over-insured for funeral. They need to consolidate, they need to consider what's in place and make sure, do I really need all of this? And can I apply this money better?
It's always about getting your facts, checking registered financial services providers, and doing your homework. That's it for Smart Money. We're thinking about your money and how to keep a hold onto it. I'd like to thank Warren and Walter for joining us, and to you at home for staying tuned. Thank you and goodbye.